You do not want to miss this episode. We're going to break down the joint venture deal. We've got a money partner, we've got a working partner, something for everyone. Let's dig into it. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. Joining me as always, Christina White. Christina, what's going on today?
Not too much, Darren. Excited to do this podcast.
Yeah, so we're going to break into joint venture. But before we do, Christina?
Yep. The regular reminder that if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. And if you're listening on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content's coming out. And don't forget to follow us on TikTok and Instagram at Control and Compound.
Okay, so the joint venture deal. So the joint venture deal is typically there's two partners. You've got a money partner and a working partner. So the money partner is someone typically, maybe a successful business owner or a successful real estate investor that's kind of winding down, doesn't want to be involved in day to day. And they go, I like these high returns of real estate. I keep, I belong to these real estate groups and I hear about these incredible rates of return and stuff, but I don't want to deal with tenants, termites, toilets, but I'd like to get those returns. So how do I get involved in it? And that's really what a money partner is all about. Now, what about the other one, the working partner?
So the working partner is the one that's going out and finding that deal, right? So they're doing the hands-on work. They're looking for the deal. They might be doing the rehab. They might be, if they're doing renos, depending on the project, they're in charge of all that hands-on stuff. And usually from going forward, property management, all of those things that the money partner does not want to be dealing with hands-on, that working partner is going to handle on their side of things. So it really gives, it's a good partnership. It brings two sets of skills to the table for them, right?
Yeah, I love it because, there's a lot of successful real estate investors out there that are hands-on. They're able to find the deals, maybe add a unit, do a renovation, increase the rents, do all that stuff. But eventually they're going to run out of money or run out of financing ability to buy additional places, or they just want to grow faster and they want to do 10 deals instead of one deal with their own money, and they can make a lot more on half of 10 deals than one on their own. And really, when we dig into where do you find these joint venture partners, like how do you go about finding a joint venture deal?
So it's like we always say, right? Surround yourself and connect with those that are doing it as well. So you want to be working with real estate investor or real estate agents that work with investors, your mortgage broker that works with real estate investors, accountants that work with real estate investors. Like surround yourself with those people because they're going to be talking and hearing about those deals that you might want to get involved in. And it's always nice to have, warm referral so they know them because you are getting into business with this person, right? At the end of the day, you are forming a partnership, so you're going to want to like them. So if you have someone that knows them personally, that's going to be a lot better. And you always want to work with someone that's doing like-minded, doing the same things that you're doing, right? So being in those groups, real estate groups are another great one. Joining real estate groups, checking, in a few of them, you see a lot of these deals pop up on Facebook, those types of places. And it's a good place to catch your eye, right? You got to do more digging afterwards, but it's a really good place to see what's out there.
Yeah, like I know, like before I get into real estate, like if you'd asked me about private lending or joint venture deals, I would have been like, how do you find these? Like, where do you go to find these? But I belong to a bunch of real estate investing groups now, and a bunch of forums, and a bunch of different conferences I go to, and all of a sudden you're exposed to this all the time when you're in that real estate investing community, and there's tons of deals out there. But let's talk about the what the money partner should be asking the working partner, right? You don't want to just, some guy off the street says, "Hey, do you want to be my partner? Give me a bunch of money and let's go do a deal together." So you really want to make sure you screen those people that you're thinking of doing a money partner. And for me, the first thing is this your full-time gig? Are you a real estate investor or a renovator? Is this what you do, or is this the very first time you've ever done it? And if it's the very first time you've ever done it, I don't know if I want to be your money partner. I want someone that says, okay, this is what I do. This is what the team I have in place, whether it be the people that are going to do the renovations, the property management, the accounting, all that stuff. Because the money partner doesn't want to do anything. They just want the return and provide the money. So the other thing I always look for is, what's your exit strategy? So if you're the working partner, you need to be able to communicate clearly what the project is, how it's going to make sense, how we're going to get the money out of it, and how we're going to exit the plan if you have to, whether that's sell it, whether that's increase the rent and rent it. But again, you want to make sure you ask the person about some previous jobs they've done or previous deals they've done. You want them to be an expert at this and be able to go through everything and say, yes, I've done this deal and this deal, and this is what we're doing. Because sometimes I've literally listened to some joint venture projects and it's like, no, I think this is a pretty good deal and we can, I don't want to hear this is a pretty good deal. I want to see a pro forma. Explain to me what you're going to do. Explain to me what the risks are. Explain to me an exit strategy. Explain to me when I'm going to get my money back. So you really want an expert. You want someone with some financial stability too. You don't want someone that has absolutely no money and all of a sudden things go sideways and they can't put any money in or can't find the people to hire to put the money in. So really got to do a really good job of screening that money partner. And then the last piece is, what do they specialize in, right? Like you have some people that specialize in, they take a 2 unit and make it three, or a 3 unit and make it four, or a bungalow and make it into a 2 unit. Like that's a real skill. Well, once you've done that 5, 10 times, you get really good at it. So I'm looking for a person with that experience. But if that person comes to me and goes, oh, I've done 4 duplexes that I've converted to triplexes, now I'm going to buy a 25 unit building and I'm going to do the same thing. Well, maybe I'll see if they can do that one successfully before I go into it because they might not have that skill set at that volume. So, again, what have they done in the past? What is their success? What is their plan? What is their exit strategy? What is their financial stability? And then, Christina, you mentioned references, right? I want to talk to people that have done this before. And a good joint venture working partner will be able to give you a list of people they've done deals with before. And then I guess one last thing, I want updates too, right? Like I don't need to be calling every day about, what's going on with the project, but I want regular updates saying this is what's going on. I did a couple of these and I get an email every month saying this is what's going on. This is what's going on. This rent wasn't paid. This one is doing. This is the expense that came up. I don't need to be involved day to day, but I want to know what's going on. So that's kind of questions a money partner should ask a working partner. Um, but it's the same for a working partner because as a working partner, you want to ask questions to the money partner because not everyone with money is a good money partner. So what do you want to ask what should the working partner ask the money partner?
Yeah, absolutely. You don't just want to work with anybody. Again, you're going into business with this person. So you really want to get to know them. You want to do those reference checks. Sometimes you might even want to do criminal record checks, credit checks, those types of things. You don't have to. Credit check, not so much, because really, when you get to the bank, that money partner is the one that has to come up with the down payment and has to get that mortgage. So they have to have good credit, right? If you don't find that out ahead of time, the bank is going to tell you that. But it is something to save you some time up front, asking what their credit looks like, if they have the funds available. Another big one is, are their taxes up to date? That's another one because you can't get a mortgage if your taxes aren't up to date. So that's important. Are you a Canadian citizen? So are you a resident of Canada, permanent resident? That's important for getting mortgages. So another question that you want to ask. Another big one is learning a bit more about their personality, right? Because your personalities really do need to fit. If you're working with a worrywart that's calling you 24/7, asking about what the next step is, that might not be the right partner for you, right? You might not want to talk to them at all times, all days. They're calling you at 11 o'clock at night because they're worried about the next day. You don't want that. So find out, are they easygoing? How much interaction do they need? Do they need a daily update, weekly update? And make sure that you're on the same terms, right? Because you might think that, monthly updates completely fine. But for them, if that's not the way that they see things, then it's not going to work for you. And you do not want to be getting into arguments, with your business partner at any point in time. And that's, again, what this is. So asking those questions. Another one is, if they're married, is the spouse or partner involved? Like, are they going to be involved? That happens in business all the time. We talk about it. We have buy sell agreements and all that stuff for that reason, put in place for business owners, because if the wife, wife, husband, partner, do they want to be involved in this job? Are they on board with the job? If something happens, where does the job fall? If there was a divorce on the other side, those are things that you want to have, looked at beforehand. So all important things to ask your money partner so that you guys are on the same terms, because you're going to put together that agreement, and now's the time to really work out all those details and have them listed in the agreement when you do that, right? And that's when we start talking decisions and deciding on how the deal is going to go down, what it's going to look like.
Yeah, because just because someone has money doesn't mean they can't be an idiot. right?
Yeah.
So do you want to be partners with an idiot? I mean,
No, you
let's
want a good person.
let's dumb it down. But I
Yeah.
mean, yeah, I like your worry warts too and the spouse. That is huge, right? Because someone goes into this, yeah, it's going to be great, and then all of a sudden their spouse is chirping in their ear every day, going, "We're going to lose our money. We're going to lose our money." Well, what's that spouse going to do? They're going to go back to the working partner and start asking a million questions. So great overview there, Christina. And then okay, so you have a money partner, you have a working partner. So the money partner is going to provide the down payment. The money partner is going to qualify for the mortgage. But what other decisions do you need to be made? And these decisions you need to make up front. You need a solid signed agreement saying this is what's going to happen. This is what's going to happen if this happens. Contingency plans. So the questions are, are you going to set up a corporation? Should there be a corporation for you guys? Are you going to have a joint bank account? Are you both going to have access to that bank account? And how much money does that need to be funded with initially? And then what if there's a problem? How are we going to resolve problems? What's the resolution technique? Is there some kind of third party? Is someone at the end of the day going to make the decision? And then the other one I find is people going in, they really need to have the same outlook. Because you could have one partner that says, "Oh, this is great. Let's do the renovation and sell it and make a bunch of money." And the other partner could say, "Well, no, I'd like to hold this for the next 20, 30 years and refinance and do more deals." So you got to make sure you're on the same page as far as time horizons. You mentioned the criminal record check. But again, if your working partner doesn't have a template for a signed working agreement, they probably haven't done this a few times because the
True.
ones I've seen, it's here's the standard agreement. This is how we're going to resolve things. This is what we're going to do for a bank account. This is what we're going to do in this situation, in that situation. And here's our plan of when we either refinance it, sell it, or, you don't have to, we're going to sell it exactly in 5 years, but you got to be both comfortable saying, we don't want to sell this in the first 5 years anyway, or the first 5 or 10 years. So, anything else, Christina, on the decisions you need to be made up front?
I think that you should have a conversation about your risk tolerance as well, right? Some
Yeah.
people are, straight into this. They can take all this risk and not worry about it. But if your, working partner's okay with taking risk and your money partner's not okay with taking the risk, that's something that needs to be talked about up front. So how much leveraging do you want to do later on with this building? Those types of things, because the problem is that when the money starts coming in, it is not the time to make these decisions, right? Money's coming in, you're earning. That's not when you go back and you decide what you're going to do with those funds. You really want to make it up front. So I think the risk thing, being on the same page there does make a lot of sense as well at the beginning.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Yeah, 'cause I mean, buying a piece of land and then trying to go get the zoning changed and then trying to get a permit to build what you want to build and that build like going through all that is a much different risk profile than buy an existing home, add a basement unit to it, right? I mean, that can go sideways, but not too sideways, right? A project with big risk like a land development, I mean, typically greater returns, but also because there's greater risk and you really need that expertise. So that's a great point. So Christina, let's do an example. What would be an example we could use for a joint venture? Again, money partner is going to provide the mortgage or qualified for the mortgage. The money partner is going to provide the down payment and the closing costs. So what would be a typical sort of example we could use to help explain this?
Yeah, so on a smaller type project, like, and these range from every type of real estate project out there you can get involved in a joint venture. But let's just go with, a $500,000 property. We got a $500,000 property, so we need to come up with 20% down. So that's 100,000 that we need in cash plus about 10,000 in closing costs, right? So your money partner is going to need to come up with 110,000 to be able to purchase that property, and they're going to have to be able to qualify for the mortgage. So that's how we get the property. Now, let's look at so we're a year out or so. Let's look at a year out. We've purchased this property. We've got our tenants in it. Let's say we've got a 4% appreciation rate. So we got a 4% appreciation rate. That's going to put the property up 20,000 in 1 year. So that's meaning because real estate, we got our dollar doing lots of jobs, right? So we've got the appreciation. We also have our tenants paying down our mortgage. So let's just say we've got $11,000 our tenants have paid down. And then we got positive cash flow in this one. So we picked a really good spot.
Good for you. A good
Yeah.
deal. I want in on this one.
Yeah, well, it's not in the GTA. Okay, so it's outside, and we've got some positive cash flow. Let's just say we got 13,000 there. You got your 20,000, you got your 13,000, and you got your 11. We got 44,000 that's been made, all in on this property that last year. So really, you got a 40% return on that property that year. So with that 44,000, if it was agreed to in the agreement up front, maybe the agreement is to split the proceeds. Well, both of you have $22,000 in that first year in business, right? And that's how that's going to look. Very simply put in what it looks like, because sometimes we have people pulling, maybe the money partner wants their money back first before we start making profits and seeing that type of thing. But that's all going to be written out in your agreement. Pretty straightforward. That's how it's going to work, right? You're going to split the profits going forward because they've done the work and the other has put up the money, and you've got that partnership for the returns.
Yeah, and we're not always going to do 40%. We're just using an example here. But again, and even in that place, it's not like you actually have that check for 44,000. You have a smaller mortgage, you have a property that's increased in value, so you're not seeing that return. But at the end of the day, that's what you're earning. So if just like everything we say, if we can combine this age-old strategy of real estate investing with this hundreds of year old strategy, infinite banking, and we put these together, it's like the Reese's peanut butter cup, peanut butter and chocolate. You put it together, it's even better. Well, the same's going to work here. So if I have an infinite banking policy and I'm the money partner, okay? So let's use your example and say, so the money partner had to come up with a down payment of $100,000 on the $500,000 property, and the closing costs, let's just say, are $10,000, so $110,000. So the money partner could use their money for that, or they could go to their infinite banking policy if they had a cash value there and borrow from the infinite banking policy for the down payment. Banks are going to be on side with that. Working partner doesn't care where the money came from. You borrow from the policy, you loan that money. You take a loan and you use that money for the down payment. You qualify for the mortgage. So now let's say that $110,000 example, let's just use 5% policy loan interest. So you're going to pay 5% of that would be what, $5,500. All right, so it only cost me $5,500 because I didn't use my money. I used the insurance company's money. My money stayed in my policy, continued to grow. And that $5,500, Christina, what can I do with that $5,500 at tax time?
Well, it's tax deductible because you invested in real estate, right?
Exactly.
So it's an investment.
So that loan is now tax deductible. So the $5,500, now again, money partners tend to be in higher income brackets. So let's assume a 50% income tax bracket. Well, that $5,500 only cost you $2,750 after tax. So for $2,750, what's happened? That's what your out of pocket is. Well, you've made $22,000 in the first year on this deal. That's about a 700% return. That's not bad, okay? But your money's also still compounding inside your policy. So we could actually add the growth in the policy to this as well. You're going to have the full growth of your cash value inside your policy, because when we take a loan, it doesn't affect the cash value. I'm out $2,750. My policy went up and I made $22,000 on this deal. Now, that first year. Now, again, you don't actually get the check, but that's what your wealth has grown. So that is huge. So typically on a working partner joint venture deal, or a working partner money partner joint venture deal, they're all over the map. Probably the most common though would be 50-50 share in the profits, okay? With the money partner getting the money back first.
Yep.
So let's say you do this deal and you go, okay, I'm going to put in the $110,000 as the money partner. But let's say 3 years down the road, 2 or 3 years down the road, we do something to force the appreciation. We do a renovation, add a unit or whatever, or we increase the rents or we fix it up or whatever. Again, that's the working partner's expertise. And then you increase the value of the property. And let's say now it's worth $600,000 or $650,000 or whatever. Well, then you go back to the bank and say, we'd like to refinance this. And typically, again, not always, that first $110,000 that comes out of that refinance or the cash flow, that's going to go back to the money partner. So the money partner basically gets their money back at the first opportunity of refinancing or using the cash flow to pay it back. And then from that point forward, all the profits are split 50-50. So any cash flow, well, that if it's 20 or 30 or 40 grand a year, well, that's going to be split between the two of them. And then when they go to sell it, the profit's going to be split between the two of them. So it's a good deal for the money partner. They get to get in this without doing really anything other than cutting some checks or maybe, spending 7 seconds to get a policy loan through an email in our office. And then they take advantage of it. They get a great rate of return. They get involved in the real estate deal, and maybe they learn a bit too, right? Like I did a joint venture deal, and even though I wasn't hands on, just the whole experience, you learn so much about how real estate works. It was a good education process, so it's really nice for people to sort of ease into that. And then the working partner gets to do a deal they probably wouldn't have been able to do otherwise because they can't do 10 deals on their own and qualify for the mortgages. So it's a win for everybody if you have the right partnership, if you have the right agreements, and there's obviously risk involved, but it's really a win-win, and the infinite banking just makes it better. We get another infinite banking example, but anything else, Christina? Just comment on that.
Yeah, no, I think that you covered it there. One other thing I always note is that loan's not showing up when they go to get the mortgage, right?
Yeah.
So very important because you're taking that out. You don't want that to impact your credit for the money partner. So that's important. And then just a note on what you talked about, like learning, right? You're working with someone that specializes in this field. We always talk about investing in you, investing in your education. This is an investment in your education. If you can go out and you can find that person that specializes in maybe burrs and that's something that you want to do and you get to work with them and you get to learn from them, not only have you gotten yourself into a lucrative real estate investment, you've also invested in yourself by learning from this individual throughout the process, right? Maybe the next one you can go on and you can do on your own. So there's kind of investments on two sides, right? When you go and you do something like this, which is kind of neat.
Yeah, and if you're a working partner listening to this, or you want to be a working partner, well, you're giving up half the profit because you don't want to put your own money into this, or you can't qualify for the mortgage. But what if you got to a point where the working partner had an infinite banking policy? They were saving tax free for retirement and all the other benefits that come with an infinite banking policy. And then they go, wait a minute, why don't I use the insurance company as the money partner and I get all the profits? In other words, you have an infinite banking policy, the working partner, and they go, oh, well, I can borrow 110,000 from my policy against my policy to go do the deal. And if they can qualify for a mortgage, maybe they can do the deal and get 100% of the gains instead of 50%. So again, we see it more on the money partner side, but those working partners, they tend to make a lot of money because they're doing a lot of deals. And then they can build up an infinite banking policy, and then maybe they can do a deal where they don't need a money partner on a certain deal. You find a great one and go, oh, this one's going to be great. Why don't I do this one on my own? So again, doesn't matter which side you're on. The infinite banking policy is going to be that strong, stable, guaranteed growth in your cash value. And then the last part is, even if you're the working partner, you still may have to put some capital in right after the down payment and stuff if things come up. So you need to store your money somewhere, and the infinite banking policy is just the perfect place to store your money. So that's joint venture, Christina. Anything else on the joint venture that we should cover?
I did want to, we talked about, this was, a pretty standard joint venture, kind of looking at a duplex or one kind of deal. But you did one recently that was really interesting. And I thought that we could chat a bit about that because I know I picked your brain on it because I wanted to hear. So I think others might want to hear a little bit about that one that you did was instead of, doing it with one partner, you did that with the multiple partners on that larger unit building, right?
Yeah, so this is it's kind of a spin on a traditional joint venture, but it was a GPLP, which General Partner Limited Partnership. So this was a 39 unit building, and what I did is I put in some money and I bought 8% of the deal. So I own 8% of a 39 unit building. And the plan there was as a limited partner, I put the money in, but I had actual percentage ownership. And the plan there is they're going to refinance it in a couple of years. They go and did a renovation, increase the rents, refinance it. So the goal is for me to actually get my money back in 2 years. Now we'll see if it works out. We're coming up to a year now. So, hopefully I think the project's going well. They're able to increase the rents. They're able to get separate power meters in, a couple other things they're doing. So if we can refinance that, the idea on that plan is that money is going to come back to me. The beauty of the refinancing is that money, when it comes back to me, let's just say it's 200,000. I put 200,000 in, and then they refinance it. That 200,000 comes back to me, and that is tax free money because that you're refinancing. It's not refinancing. It's like a return of my capital. So I'm not going to pay proceeds on that, but I'm still going to own 8% of the building. So if they are able to refinance it and then basically give me my money back, and then I still own 8%, well, great. There's going to be cash flow in that long term, and there's going to be refinance opportunities probably every 5 years that more money can go out, and eventually someday the building will be sold and you share in those profits. So it's another way for really a money partner to be involved in real estate, reduce the no liability on this one. You don't have to qualify for a mortgage on this one, and you have all the upsides of real estate, and you're dealing with an expert on that. And then that tax efficient money is coming back. Refinancing, again, is going to be tax free. So again, there's variations on it, but it's all comes from being in that real estate investing community, right? I never would have heard about these deals if I was, had all my money in RSPs and went to the bank for advice, and that's all I listened to. I was able to find these deals because I'm part of real estate investing communities. So that would be my big thing is if you want to be a joint venture, working partner, money partner, get involved in a real estate community.
Well, yeah, and if you want to be that money partner, get your money in your infinite banking policy first, because I know for a fact you didn't put up 200,000 of your own money for that deal.
Well, no.
You paid the interest.
There was a large insurance company kind enough to loan me
cut that check.
$200,000 because I asked, and they said yes. They didn't ask me what it was for, when I was paying it back, whether it was a good investment. They just said yes because contractually they're required to
gotta
do
do
that.
it.
So again, multiply your money and do multiple jobs with that money. Have your money in more than one place at the same time. That's how we're going to get ahead.
Absolutely.
Awesome. Thanks for watching. Thanks for listening. Great episode, Christina. Appreciate it. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.